Welcome back. The Reserve Bank jolted the country on Friday evening with its decision to withdraw the 2,000 rupee notes. But economists are still trying to grapple around what this might mean to the system. It is important to. There are some who believe, of course, that there will be, a consumption of gold, perhaps, and not all the money will be brought in as deposits. But we have to remember that the two have to be distinguished from the demonetization of 2016. First of all, the amount of money is 3.62 lakh crore. In 2016, the amount of money that had to be returned was as high as 15 lakh crore. Also, now the Reserve Bank clearly says that the 2,000 rupee notes are legal tender, whereas now in the demonetization, the notes were clearly cancelled. They could not be used to purchase goods and services. So the two are clearly different. Yet, what will be the impact of all this money, 3.62 lakh crores, comes into the banking system? I have with me the chief economist from Goldman Sachs India, Santanu Sengupta. Santanu, good morning, and thank you very much indeed for joining me. Well, first up, this consumption of gold, a lot of people expect that perhaps those who stashed the money in their homes may not want to reveal their identity. Are you expecting a consumption spurt?
Yeah, thanks, Lata. So there were some media reports over the weekend that the purchases of gold had gone up. Our sense is that ultimately, whichever route it takes, most of the 2,000 rupee currency notes will have to come back to the banking system and add to banking system liquidity. As you correctly pointed out, the total value of the notes have already declined from 50% of currency in circulation to about 11% by the end of fiscal year 23. The peak value was 6.7 trillion or 37% of currency in circulation. So from an overall currency in circulation or money supply point of view, this is not anywhere close to as big as demonetization. Also, you have a 4-month window for this exchange to happen. But our sense would be that most of this will come back into the banking system and add to banking system liquidity over a period of time, though.
Mm-hmm. So what does it mean? I mean, today we have seen call rates go down by about 10 basis points, and across the curve, shorter term paper has gone down by about 3 to 5 basis points. Likewise, the 10-year also were marginally lower. What is the longer term implication in terms of MPC, the Monetary Policy Committee doing something because liquidity is still good? They don't change their stance. Any other impact?
I think from a monetary policy point of view, the only part that this impacts is the short end of the curve. Unlike demonetization, which was impacting majorly the long end of the curve also, because you had a shock to the economic system in terms of activity during that time. But the near-term activity shock this time is likely to be muted, in our view, because by the RBI's admission, this denomination is not being commonly used for transaction. The stock of other banknotes is also adequate to meet the overall currency demand for the economy, according to the RBI. And additionally, you have a significant increase in digital payment infrastructure and digital payment transactions now, versus demonetization, and obviously which has picked up post-COVID. From a liquidity point of view, if you roll back, 2 weeks, you had a liquidity tightness in the system. Overnight rate was closer to MSF, and the system was grappling with this tightness. And there are two things that have happened. One is that the RBI came out with the variable rate repo auction, which already eased liquidity. Then you had this news overnight, which over the foreseeable future, that is the next 4 months or so, will be further easing banking system liquidity. And thirdly, which is more structural, in our view, the balance of payments will be flat this time, driven by strong services and remittances growth. So the current account deficit is something that we are anticipating we are forecasting at 1.4% of GDP for calendar 23. And even with conservative assumptions on capital flows, that will mean a flat balance of payments. So from the RBI's point of view, and from the market's point of view, the liquidity tightness is being taken out. That scenario is being taken out for now.
Any expectations of whether this postpones a CRR cut? Were you even factoring in one?
We were not factoring in a CRR cut in our forecasts. Yeah.
Okay. Okay. What's your, I mean, aside from all this, what is your sense on growth itself? I mean, there are such conflicting developments. We have PMI numbers which came in very strong. At the same time, there is a lot of slowness expected in global markets. Our services are doing well, as you point out in your report, services exports are doing well regardless of the global slowdown. So are you upping, downing? What's your growth forecast for the current year?
So we have a 6% growth forecast for calendar 23, which is slightly above consensus. See, the growth has, multiple levers. One is that the services, as you pointed out, that's holding up growth, both from the external demand side as well as domestic demand side. The discretionary consumption, some part has slowed down, which was, again, anticipated after you had the rebound post the pandemic lockdowns. On the investment front, as we have seen, it's only the government which is carrying on with the infrastructure stimulus. The private sector is not quite there in terms of increasing the aggregate investment rate of the economy. So if you're at about this 31% investment rate, the private sector hasn't done enough yet to really increase it towards a 34% or so. But we think that the supply side conditions still are pretty conducive for the private sector to come in whenever they do. And finally, on the net export front, the drag now is lower than what we were anticipating, say, 3 months back, because of one, services trade running better than our expectations, and two, remittances also are clocking about 3.2% of GDP now, which is about 50 basis points higher than what you were doing pre-pandemic on average. So on balance, this puts the current account deficit again in the 1.4% range, and therefore comfortable from the external balances scenario.
Okay. So therefore, you're expecting a rupee strengthening. You do point out that there is a very strong remittances inflow into India compared to a couple of years ago, as well services exports. So no rupee strengthening?
So rightly, in this kind of a scenario, you would anticipate rupee to strengthen. The reason why we have thought that the rupee will not strengthen and will be capped in this 82, 83 kind of range is because the banking system was going through this liquidity crunch, and it was effectively a free pass for any central bank to, in the face of inflows, to acquire in spot and keep it unsterilized to add to the liquidity. Depending on how much liquidity actually comes into the banking system and what is the kind of drain that you see as you get into the festival period, which is over the next couple of quarters, the Reserve Bank will then decide on whether it wants to leave the FX, let the FX hit the dollar inflows hit the market and let the rupee appreciate, or whether it decides in the face of higher liquidity to suck it out through other instruments. It really then becomes the central bank's call. Okay. Our sense is that the RBI will be leaning against any inflows and shoring up reserves, because that have helped them manage the external worries in 2022.
Okay, so the rupee will be where the RBI wants it to be, and your best guess is 82 to 83. Okay, Santanu, the issue really is, the confusion with respect to this withdrawal of currency notes. The Reserve Bank, on the one hand, says this is legal tender. They never said that in 2016. And yet there is a deadline which has made people, guess or try to say that post September 30, it won't be legal tender. Do you think the central bank will kill its own credibility so much as to call it legal tender today and say not legal tender on October 1st? What's your best guess?
From the press release, what was clear was that the holders of these banknotes may deposit any amount of the notes to the banks or to the RBI offices and exchange up to 20,000 rupees at a time starting May 23rd up to September 30. It is not clear from the press release what would happen after September 30, but the release has said, without specifying a date, that the banknotes in 2,000 rupees denomination will continue to be legal tender. So that's what we know from the press release until the RBI comes in with further clarifications.
Okay. Well, I'm weighing that the Reserve Bank can't be, sacrificing its credibility so much. But I was just wanting to know if what your views would be. Finally, when are you now penciling in a rate cut? There is a little more liquidity than we thought. There is a slightly higher dividend than we thought, which might all keep yields a little controlled. And of course, inflation readings are lower. So rate cut expectations, if any?
Yeah, so we haven't changed our rate cut expectations. It's still into next year in the first quarter. On the inflation front, the downward surprises that you have been from food prices, which we are baking in some kind of reversal in the next quarter, especially perishables like vegetables. It's difficult to sustain at this level for a long period of time. Core goods inflation is coming down in line with our expectation. Core services inflation is what has surprised us in the last month or so, because we were baking in a higher core services or a sticky core services inflation going forward, given what is happening on the growth front. So if core inflation remains in this 5 to 5.5 range as you go into the second half of the year, which is our projection, then I would imagine it's difficult for the central bank to ease in this year, but next year is when we are baking in some easing, depending on how the global cycle goes.
Okay, so 10-year doesn't go above 7% in your book.
Sorry?
10-year yield doesn't go above 7% in your book.
We don't put out a forecast for the 10-year, but I would say that the conditions, especially over the weekend, are making this conducive for long bonds.
Oh, okay, for yields to remain soft. Okay, thank you. Thank you very much, Santanu Sengupta, for joining me with your thoughts on several things, the withdrawal of notes and the current account, which is heading very nicely towards perhaps a very low deficit. We wrap up on Bazaar on that note. Markets extremely quiet in terms of the red and the green. The red was ranged and the green is ranged. Let's see where it goes. Chartbusters will take the action forward.